Welcome everyone to today's lecture in financial risk management. Last week we stopped in our discussion of backtesting with the distinction being made between in-sample and out-of-sample forecasting, and thus out-of-sample and in-sample forecasting accuracy. We saw that you can take a data sample, say 2016 and 2017 data. You can make a cut right at the change of year, and then you can use 2016 data to estimate your model, and then do out-of-sample forecasting, in German Prognose, and try to forecast tomorrow's values as good as possible. And then if you see that your in-sample fit is good, and if you see that your out-of-sample forecast and fit is good, you have a good risk model. And in backtesting, you try to assess the accuracy of your risk model based usually on, first of all, in-sample forecasting, but more importantly, out-of-sample forecasting. Okay. I stopped here with this discussion of in-sample and out-of-sample forecasting, and as you can see, I did all my drawings on this slide, and we'll now come to backtesting and some examples of backtest before we talk about stress testing. Now, what is backtesting? Backtesting refers to the process of evaluating the accuracy of a risk model by applying the model to historical data and then checking for the appropriateness and assessing the accuracy of those forecasts. Now, the usual exemplary steps of such a valued risk backtest would be: you estimate a parametric or non-parametric risk model with which you estimate the valued risk based on an in-sample. You then predict out-of-sample values as a VAR threshold. You compare those forecasted VAR values with the realized values. You check those differences, and based on those differences between the actual losses and your valued risk out-of-sample forecast, you can assess the accuracy of your model. For example, you would use this data, forecast this day, and if you see this is the valued risk you forecasted, your actual loss is here, it's okay. Then you will forecast the next day. For example, this would be your VAR threshold. Your loss is here, still okay. Then you estimate the VAR at this level. You see, oh, the actual loss is way down here. So you have a VAR hit. You have an exceedance. Your VAR threshold is exceeded, and you have 0, 0, 1, 0, and so on. And this is then the hit process that will be used in formal statistical backtests. So what do you need? First of all, you need to select a period, a data sample on which the backtesting will be performed. You will use historical data, obviously. In many cases, in market risk management, where you have daily data, you will use, say, 500 trading days to estimate your model. And then the data sample will be converted or split up into a training data set. That's the in-sample, and a test data set on which you will test your model forecasts. So, for example, you can use the first 300 of your trading days and then do out-of-sample forecasts for days 301, 302, and so on up until 500. And then those forecast values of the model are compared with the actual losses, which are obviously known if we have split up our 500 days into 300 days and 200 days. And ideally, the model should accurately predict each realized out-of-sample value. And as a perfect prediction is not feasible, you will at least hope for the threshold of your VAR estimates, of your value of risk estimates, or the expected shortfall estimates, to be as good as possible. Now, one has to remember, these are very basic forecasting models from statistics and time series analysis, meaning that in the end, if you do out-of-sample forecasting, you are trying to predict tomorrow's lottery numbers. And you will never hope for an accuracy of a model of 100%, meaning that you are able to completely forecast tomorrow's losses. You will only hope for an accuracy that is as high as, in the sense that the threshold, the lower bound for your losses, is more or less accurate. But if you were able to forecast tomorrow's profits and losses, well, good luck, then trade on it. So on the basis of the found results, and if you see that your model is inadequate, has some weaknesses, you will then try to improve or correct your model. Now, again, remember that those forecasts, let's do it differently. Those forecasts are used to calculate regulatory capital. So the easiest way to come up with a good fitting lower bound is, of course, just to say, well, my lower bound, my valued risk estimate is this. In this case, you would be very pessimistic. You would simply assume tomorrow we are all dead. That's too pessimistic because you're wasting risk capital. If you were to say, this is my lower bound for the losses, you would be way too optimistic. Then you would have too little risk capital and you would at some point go bankrupt. So you need to find something that looks like this, a lower bound that is pessimistic enough, but a lower bound that is not too optimistic, a risk model that is more or less accurate. And it makes sense that a risk manager is always intrinsically interested in such a good fitting risk model, because a risk manager should manage risk, it should keep risk under control. However, with banks and financial institutions, you also have a legal obligation to do such backtesting. For example, if you look at paragraph 318, sentence 1, the German Solvabilitätsverordnung, that is mandatory for banks in Germany, it requires that the forecasting quality of a risk model, it's a translation obviously, the forecasting quality of a risk model has to be determined using a daily comparison of the potential risk amount calculated on the basis of a holding period of 1 working day with a change in value of the individual financial instruments or group of financial instruments included in the model calculation. So bank regulation requires banks to do backtesting. It's not an option, but you have to do it. And BaFin, as one of the German agencies, federal agencies in charge of banking supervision, will assess the quality of your risk models, and they will also assess the quality of your backtesting models. If you just say, I have this model in place to estimate valued risk, and I'm doing this or that for backtesting, BaFin will say, okay, your backtesting is fine, or you need to do more to backtest your risk models. Okay. Now let's see what types of backtests you can do. First thing you can do is you can test for the unconditional coverage of your risk estimates. That is, you can ask yourself how often the realized losses were higher than the losses predicted by the risk management, how many hits you've taken. So if losses exceed the valued risk much more often than expected, risk manager may not have made enough appropriate reserves. Otherwise, losses are always lower than predicted by the models. The model is too conservative. That's the case down here. It's way too conservative, it's way too pessimistic, and it's not desirable because the profit margin of an investor would be significantly lower. We are wasting capital. We are wasting risk capital. Now, if in total there are more VaR violations than expected, the model underestimates extreme risks, leads to more losses than expected. If you have too few violations, model is considered to be too conservative. Thus, we need a test that tests for the correct number of VAR violations, the right number of VAR hits, of exceedances. And if, for example, we have 100 days, alpha is 5%, then we would expect 5 exceedances. Not 20, not 0. We need to test for the number 5 as the number of VAR exceedances we need for the model to be correct. And any statistical test that tests for this right and correct number of VAR exceedances is called an unconditional coverage test or just an unconditional test. Very simple example. It looks complicated, but it's actually quite simple. Let zt be a real random variable or a set of real random variables, and var_t be the value at risk at excess coverage level alpha between 0 and 1. Then we define the function ht by the indicator function, an indicator variable for zt smaller or equal than minus var, meaning that ht is 1 if we have a hit, it's 0 otherwise. And that's what I showed you here. If these are your losses and this is your value at risk, we have 0, 0, 0, 0, 0, 0, 1, 1, 1, 0, 0, 0, and so on. And this is ht. ht is 1 if you have a hit. If your var is exceeded, it's 0 otherwise. Alternatively, the hits can also be defined by the losses. In this case, we have profits and losses. It's just a matter of definition and a matter of sign. Now, you test the hypothesis of unconditional coverage, meaning that the expected value of ht minus alpha is 0. Why is that? It's a very simple statistical significance test. ht is supposed to be what? It's a sequence of ones and zeros. What is the expected value if the model is correct? If the model is correct, the expected value is alpha. Alpha minus alpha should be 0. So you could have also said the hypothesis is expected value of ht is alpha. Put it into the left, on the left hand side, and it's simply expectation of ht minus alpha under the given informations omega t minus 1 should be 0 almost surely for all alphas. It doesn't matter if you have the 1% or the 5% or the 10%. Very simple significance test. Just like in any regression analysis, you do a test. Most popular test is the so-called Cupids test. I think it's Cupids. It's named after Paul Cupids, a researcher at the Federal Reserve System. And it's the most popular test of unconditional coverage. Very simple one from 95. And you take the shortfalls, ht, or the hits, for the n predicted values, and you calculate this test statistics, kn. It's simply ht minus alpha. You sum it all up, divided by the square root of n. For example, if you have 1,000 days, you will take the square root of 1,000. And this is your test statistic. And you can see it symmetrically tests whether you have too many or too few hits. If you expect 5, if it's 20, if it's 0, the test will reject the hypothesis of unconditional coverage. Very simple statistics. The violations under the null hypothesis, they should be Bernoulli distributed. Should be Bernoulli distribution, meaning that they are independent and it's the same case as in your basic statistics class. You have an urn, you have red balls, you have black balls. If it's all independent and you have a set of red balls in the urn, you take your hand, you pull a number out, or you pull one of the balls out. What is the probability that it's a red ball? Well, Bernoulli distribution. So with the Bernoulli distribution, you can easily show that for n to infinity, this approaches a standard normal distribution. So to test this hypothesis that your coverage level is indeed alpha, you can take this test statistic, Kn, and then you can use critical values of the standard normal distribution. And that's a very, very simple test. Now, more interesting are tests of conditional coverage. I think last week I already talked about situations like this versus situations like this, or something like this. Under the null hypothesis that the risk model is adequate, the var exceedances, the var hits, should be independent in time. So we have to prevent two scenarios: symmetric changes and systematic changes, and clustering. So the hit sequence of ones and zeros needs to be random in time. We don't need just the correct number of exceedances, but they should also appear randomly in time. And for this, we need to test for the independence of the hit sequence. So a simple test would be the hit sequence, HT, is IID. IID stands for independently and identically distributed. All those hits have the same distribution, same probability, and they are independent from each other. If we have a 1 here, the probability for a 0 in the next step is the same as the probability for a 1 again. So we have an independent series of hits. IID, be careful in German. IID in English is independently, that's okay, but identically distributed, identisch verteilt. I'll say this in German. Seien Sie vorsichtig im Deutschen mit identisch verteilt. Im Englischen unterscheidet man sehr stark, oder was heißt sehr stark, aber man unterscheidet zwischen identical oder identically distributed und uniformly. Im Deutschen klingt das ähnlich. Identisch verteilt und gleich verteilt. Sprachlich macht das keinen großen Unterschied, deswegen wirft man das gerne mal durcheinander. Identisch verteilt heißt aber, dass alle Zufallsvariablen dieselbe Verteilung besitzen. Sie sind identisch verteilt. Wenn ich also weiß, x ist normal verteilt mit 5 und 18, dann ist auch y genauso verteilt wie x, also normal verteilt mit 5 und 18. Uniformly distributed im Englischen ist die Gleichverteilung. Und die Gleichverteilung, die Uniform Distribution, ist das, was wir beim Würfel haben. Alle Zustände haben die gleiche Wahrscheinlichkeit. Das ist die Rechtecksverteilung. So kann man sie im stetigen Fall besser beschreiben. Und hier sprechen wir über identische Verteilung. Wir kennen sie nicht, aber wir wissen, es ist überall die gleiche. Für jedes H1, H2, H3 und so weiter. One example of such a conditional coverage test is now given here. You can use the autocovariance function. What is autocovariance and autocorrelation? Can anyone describe to me what autocovariance or autocorrelation is? Auto as in self. What is autocorrelation and autovariance? In statistics, you can look at the cross-section of a data sample and the time series. For example, let's assume now that we are looking at very famous socioeconomic panel of German households. We are all parts or form a household, and this, you might know this, the socioeconomic panel asks a representative sample of households in Germany each year. How much money do you earn? How much money do you spend? How old are you? Etc., etc. Now, let's assume that we have data on all of us today, last year, 2 years ago, 3 years ago. Then, for example, I could look at income, household income, and I could calculate the correlation between your income and my income, or our different incomes at this point in time. Could be possible. However, I can also calculate the autocorrelation. Autocorrelation means the correlation of any variable for one object in your sample, that could be me, now, 1 year ago, 2 years ago. And by definition, there will be some correlation, usually will be some correlation between my income today, my income last year, my income 2 years ago, and this is called autocorrelation or autocovariance. So the dependence, the correlation or covariance between different random variables in a time series at different points in time. And obviously, my income tomorrow and next year will be highly correlated with my income today. And here, this is the same. If we have a time series, and this is a time series of ones and zeros, we can look at the correlation between one point and the next point. So we'll look at this, and this, and this, and this, and this, and this, and so on, and we'll calculate the autocovariance of this hit sequence. When would the risk model be ideal? When would it be acceptable? If, and only if, what is the case? If what were the case? You can see it here, covariance between HT and HT minus J. If, and only if, all those autocovariances are zero. If it doesn't matter if we have now a zero, it has no influence on whether next there will be a 1 or a 0. Or in 2 steps, or in 3 steps. By the way, these covariances and autocorrelations are one important aspect of time series. And if you have a stationary time series, you will have autocovariances and autocorrelations that are 0. Can you give me a very good example, perfect example, where people always think there are autocovariances, where in fact there are no autocovariances or autocorrelations? My perfect example of institutionalized stupidity, where people are really expressing their stupidity and their fear of knowledge and science. Has anyone ever been to Las Vegas? If you ever go into a casino in Las Vegas, at every roulette table, you will see an LED display of the last 20 or 30 numbers in red and black. And the idea is that if you see the last 20 or 30 numbers, in your head, you're assuming there is autocorrelation. If I have now seen 20 black, the next one should be red? I don't know. So you're assuming there is autocorrelation, where in fact there isn't. You have completely independent draws at the roulette table, and even though statistically, if it's a fair game, and you can assume that it's a fair game, there should be no autocorrelation, people still hope in positive or negative autocorrelation, for what reason whatsoever. In this test here, looks at the autocovariance function of these hits. Hit today, next step, 2 steps, 3 steps. The difference between t and t minus j is what we call a lag. For example, if you're looking at t and t plus 1, it's a lag j of 1. If you're looking 2 steps ahead, t and t plus 2, the lag is 2. And we are simply doing what here? We'll estimate the autocovariance function, and then we'll take a number of lags, and then we'll look at the following test statistics. We'll take these autocovariances, change it a little bit, square them, and we'll take the sum of these squared autocorrelations. And what is the null hypothesis if the risk model is adequate? That the squared, or the sum of squared autocorrelations is ideally 0. That there are no autocorrelations between the hit now and the next step, 2 steps, 3 steps, and so on. Because if I gave you the information that it's a clustered hit sequence, and I'm telling you we have n equal to 10, and it's clustered, and alpha is 50%, then you would know autocorrelation. There needs to be 1, 1, 1, 1, 1. So this is the case you want to test, that the autocovariances, equivalently the autocorrelations, they are all 0, or they are statistically insignificant at least. This test is due to Berkowitz, Christofferson, and Pelletier. Christofferson used to be a professor of finance at the University of Toronto. And this is one example of a conditional test. You can also use a similar approach. There's one test by Christofferson and Pelletier from 2004, which is based on the intervals between the var hits. And it tests the so-called Markov property, Markov Eigenschaft. It looks at 4 probabilities. What are the empirical probabilities for a 1 following a 0, or a 0 following a 0, and a 1 following a 1, and a 0 following a 1? Those are the 4 probabilities: pi 0, 0, 0, 1, 1, 0, and 1, 1. And then they come up with the so-called likelihood quotient test, likelihood quotient test, using those expected and empirical transitional probabilities, and then they test the whole model for having Markov property. That's a different test. I'll say this in German, because you will see this in many, many areas of finance. Die Markov-Eigenschaft ist an vielen Stellen in der Finanzierungslehre, taucht die immer mal wieder auf. Die Markov-Eigenschaft heißt, dass ein Prozess gedächtnislos ist. Also es interessiert mich nicht, was gerade passiert ist. Morgen passiert etwas völlig Unabhängiges. Und damit ist die Markov-Eigenschaft natürlich in fast allen Bereichen der Finanzierungslehre, bei arbitragefreien Märkten, aber auch in der Volkswirtschaftslehre, ist die Markov-Eigenschaft immer das Instrument, um faire Spiele zu modellieren. Es ist egal, ob ich jetzt rot gesehen habe am Roulette-Tisch, der nächste Wurf ist wieder ein neues Spiel, ein neues Glück. Wenn es jetzt so wäre, dass wenn ich jetzt 10-mal rot gesehen habe, dass danach schwarz folgen müsste, wäre es ja ein unfaires Roulette-Spiel. Deswegen Markov-Eigenschaft ist ganz eng verbunden mit der Eigenschaft eines fairen Spiels. So Markov property is closely related to the property of a fair game and the idea of a fair game, because the next game and the result of the next game is completely independent of what we've already seen. And Markov time series that have the Markov property are so-called, they don't have any memory. They don't remember what we've seen in the past. The next event will be a completely independent one. So it's a fair game. Okay. To show you that it's not just an academic exercise we're doing here. I've plotted here some results from a research paper of mine. I actually don't know which one this is, but I've written a couple of these on this topic. You can see the data and the VAR model, and the black lines, those are the actual returns on, I think this was an index. And you see different types of models, different ways of estimating a valued risk model, and the red lines show you the VAR hits. Now, they all look okay, but this is just a gut feeling. If I were to show you something like this, well, everyone would say, okay, this is not such a good risk model. But here, you need a statistical test that tells you whether the risk model should be rejected or whether it cannot be rejected. But you need a formal statistical test. Ja? Also, mit dem bloßen Auge kann das niemand entscheiden, ob das Modell jetzt passt. Sie brauchen einen statistischen Test und der muss Ihnen dann sagen, Hypothese, Anzahl der Unterschreitungen ist richtig, die sind unabhängig, das muss dann mit dem statistischen Test abgelehnt oder nicht abgelehnt werden. Okay. That's backtesting. There are a couple of backtests around. Some people are still working on backtests. For valued risk, it's not such a big problem. It gets more tricky and it gets more interesting with expected shortfall, because with expected shortfall, you have much less data to go with, and you need more elaborate statistical tests to show statistical significance based on small sample sizes. But now let's turn to stress testing. Stress testing is closely related to backtesting, but a little bit different. A stress test is a process in which the effects of extreme, adverse or crisis scenarios on individual companies are examined, and you can check the forecast of a particular risk model as well as the effects on the entire company or even on an entire sector or an entire economy if it's done by a central bank. And in this process, you will assign extreme values to model parameters or to exogenously given risk factors. You will try to use unfavorable, adverse scenarios, assuming, for example, unemployment goes down, unemployment goes up by 10%, GDP growth goes down by 5%. And in the form of a scenario analysis, you will then look at the model and what comes out of the model if you're using very adverse scenarios. So for a market risk portfolio, you would probably assume market prices go down by 10% on a day. How much money would you lose? And in the following, you can use some key metrics, for example, Tier 1 capital ratios, profitability, probability of default, because in the end, with a stress test, because you're thinking and you're using very adverse scenarios, this is a tool you will only use for testing your resilience in case you're closing in on bankruptcy. You're not really interested in stress testing to check whether you have 5,000 or 10,000 euros losses, but you're interested in the global effects on your company as a whole, whether you are able to withstand such a critical hit on your business or not. And then it's quite clear why you can distinguish and differentiate between micro and macro stress tests. You can do this for your own company. For example, if you take there's a perfume store. If you take the perfume store, it might do a stress test and make a scenario that the overall perfume sales in Germany go down by 20%. And then they can make a scenario analysis and see how many stores they would be forced to close down and whether they can continue operations. But you can also do macro stress tests, and you can, as a central bank or a financial supervisor, you can have a look at your whole banking sector and see how many banks would go bankrupt next year, or how much capital would these banks need in case the financial sector goes down. Then you have a macro stress test. This is usually conducted by central banks or by financial supervisors, and you intend to test the resilience of the whole sector or the whole economy in case exogenous risk factors are adversely affected. Very simple example of a micro stress test. You have some idea how your profits look like or how your losses look like. You have a function that looks like this with an expected loss and variance. You have unemployment rate, GDP, and then you simply assume, okay, unemployment goes up by 10%, GDP growth goes down by 10%, what will happen? And then you calculate those hypothetical losses, and if you are able to withstand even these high hypothetical losses, then it's okay. If not, you have a problem. So if you, for example, here, unemployment rises by 10%, simultaneous collapse of the entire economy, then in this very simple example, you would estimate a hypothetical loss of 4.05 million euros. And then you need to deal with this. You need to make sure that you have some things prepared, what to do in case of such an adverse scenario. Now, stress testing is less common in industrial firms. It is common in financial institutions. Banks and insurers will often use stress tests to see how their business will fluctuate. For example, if you take an insurance company will always do stress tests when it comes to changes to the level of interest rates, because most of their business is highly dependent on the level of interest rates. And insurers, especially life insurers, will do stress tests and will be forced to do stress tests to see how their business will fluctuate in case of changes in interest rate levels. However, not only do central banks do stress tests, in the European Union we've seen several rounds of the EU-wide bank stress tests, in which the European Central Bank did a comprehensive exercise in which all systemically important large banks were included in the EU-wide banking stress tests. So these were called the European bank stress tests. The idea was to stress the whole European financial sector, or the banking sector at least, and was done by the European system of central banks and the European Banking Authority, the EBA, and it was used to test the stability and to verify the stability of the European banking system. Now, let's look at the one from 2014. The aim of the EU-wide bank stress was to check the stress on the largest systemically important EU banks in the case of extreme shocks to the economy. For example, one shock was an economy slump, minus GDP growth goes down by a certain amount of percentage point. And the aim was to identify weaknesses in the European banking sector at an early stage and to be able to counteract. How would you counteract if you knew which banks could get into trouble if there was another crisis? Die ultimative Keule der Regulierer, the ultimate weapon of financial supervisors in almost all those scenarios, capital requirements. The idea was to identify those banks that need a larger capital buffer to have enough capital on their balance sheet in case such a scenario became reality. 128 banks and banking groups from the Eurozone participated in the European bank stress test, 24 from Germany. First, what the stress test did was to assess the quality of the bank's asset. There was the AQR, the Asset Quality Review. Meaning what? Well, again, remember what I told you about how basically capital requirements work. Capital requirements work in the way that on the liability side of your balance sheet, you take equity plus a little bit extra. On the asset side, you're looking at risk-weighted assets. For example, let's make a very simple example. I start a company and I start with 5 million capital, and at first I have 5 million euros lying around in cash. If I have 5 million in cash, then my asset quality is perfect because I have all of my assets in liquid assets on my asset side in the balance sheet. If I now buy up a real estate property, the quality of those assets depends on how easy it would be for me to sell those assets. And if I am a bank and if I've given out loans, well, there could be good loans and there can be bad loans. And thus the quality of my assets will differ, and the European Banking Agency, together with the European Central Bank, they assess the quality of the assets of the banks. And obviously not just based on the balance sheet, but based on an in-depth analysis of confidential data. These are central banks and the supervisors who did this, and they had access to all the confidential data of the banks. Based on this, then, based on the analysis of the quality of those assets of the banks, then they did an asset quality review and then the stress test. Very simple. In my example, if I buy 5 million in real estate property in Leipzig, and then the stress test could be property prices in Leipzig go down by 20%. How much money would I get if I were to sell all my real estate property here in Leipzig? Do I get 3 million? Do I get 2 million? Depends on this extreme scenario. And then if I only have 1 million in capital and my asset quality goes down, then of course I might get into problems. This was done by the European Banking Authority, by the EBA, and the European Central Bank. And the stress test was carried out in cooperation between EBA, national supervisory authorities, European Central Bank, and national central banks. The test is subject to a uniform methodology for testing all major EU banks. And during the stress test, the examined banks must show how their endowment with particularly resilient equity, that's the CET1 capital, Common Equity Tier 1 capital, meaning best of the best, how it develops over a period of 3 years under certain assumptions. Large number of possible risks are assumed. For example, the risk of credit defaults, significant changes in market prices, securitization, country risks, financing risks, very elaborate test. And those were the scenarios. The base scenario was overall economy will continue to develop in the same way until 2016, as assumed today, back in 2014. This means GDP growth of 1.5%, 2%, and 1.8% in the years 2014, 15, and 16. Adverse scenario was macroeconomic crisis. GDP growth is minus 0.7, minus 0.1, and just 0.1% in those 3 years. And accordingly, employment will also decrease. And this, of course, is a major recession. If EU-wide GDP growth is negative, minus 1.5%, that's a huge recession. Then the European Systemic Risk Board developed these indicators for all banks. They said that in order to pass the stress test, you need to show a CET1 ratio of at least 5.5% in the adverse scenario, And in the baseline scenario, the threshold is 8%. That was the target to pass the stress test. And if the stress test reveals that a bank does not meet the equity requirement, the institution in question must quickly close this gap. Therefore, you have several deadlines, receives 6 months deadline as long as the requirements for assets have not been fulfilled. If the target threshold has not been reached in the baseline scenario, and 9 months if the target threshold was not reached in the adverse scenario. So you had some time to comply with these thresholds, these capital requirements. On average, in 2014, the stress test led to a decrease in the average CET1 ratio from 11.1% to 8.5% within 3 years. 24 banks failed the test, and the common loss totaled 25 billion euros, meaning that you would need to inject around 25 billion euros in capital into those banks that were close to fail and to go bankrupt under the adverse scenario. Main causes of these consequences are credit losses and an increase in total risk exposure. Only German bank that failed was Münchner Hypothekenbank, not a very famous one. Second EU-wide bank stress test was conducted in 2016. 53 European banks participated. Adverse scenario depicts 4 systemic risk factors, and so on and so on. If you take, if you go to the PDF, I've included the link at the European Central, I think it's at the European Central Bank. You just have to click on link, and then you can get to the results of the 2016 EU-wide bank stress test. Those were the 13 biggest losers in 2014. This one, is anyone from Italy, maybe? Okay. Monte dei Paschi di Siena is now infamous for being the Italian bank that has the most problems currently in its loan portfolio and has had for the last couple of years. And it's not a big surprise that Monte dei Paschi di Siena was a big loser in the EU-wide stress test. However, one has to take these results very carefully from a research standpoint. Why? First of all, a couple of years ago, I talked with people involved in this stress test at a central bank, and they said, quote, start quote, we still have a lot of work to do. We have to fine adjust the results. What does it mean? It means the results of these stress tests, at least in my opinion, they are predetermined to some extent. The European Central Bank wants to force bank, and the EBA and BaFin and Deutsche Bundesbank, they all have one goal. They want to force banks to increase capital. Ideally, they would like to see every bank operating with a capital ratio of 20%. They cannot directly force all banks to do that, but they can try to isolate some of them, and the biggest losers in this case, and tell them, you're a bad boy, increase your capital ratio. What would happen if the result would have been everything's fine? Then people would start to argue, then why don't we decrease capital ratios? Banks would immediately start to call for lower capital ratios. It would be cheaper for them. And European Central Bank and the EBA would be in a very delicate situation to argue why they are keeping capital ratios so high if even a stress test shows no problem. Even in the adverse scenario, there is no problem at all. What would the result be if the stress test would give the extreme opposite result. Result is our financial sector is already dead. It's a zombie sector that is only kept alive by, well, probably the state. Markets would react to that, and all investors would immediately start selling off their stocks of banks, just like in the financial crisis. So the result of any stress test, of any list of systemically important insurers, systemically important banks, the result will almost always be there are some bad boys, some bad examples, the rest is fine. So we are safe for now, but we have to stay vigilant. That's always the result of these stress tests. Yeah? We are just fine, but we need to keep our guard up. And so, not surprisingly, you have some losers, you have some banks that failed the stress test, but imagine what would have happened if the stress test would have shown Deutsche Bank would fail. Also, it's a political process. You can see Italy, Portugal, France, Belgium, Greece, Cyprus, Italy, Greece, Slovenia, Austria, Ireland, and also one German bank, meaning that what would happen if the results of the stress test would have shown we have 25 banks that failed the stress test. Coincidentally, those are 25 Greek banks. Then the next day, when markets would open, the Greek economy would be in crisis again. So again, here you see this as a result, more or less, of a political process in which all the governments want at least one to feel important and to have some reason why to act, but they don't want too many banks that fail the stress test. Ist, denke ich, jedem klar. Also gerade solche Stresstests oder auch solche Listen mit systemrelevanten Instituten, das ist ein Gefrickel hoch 10 auf der politischen EU-Ebene, weil es dürfen halt nicht zu viele sein, es dürfen nicht zu wenige sein, jeder will irgendwie ein Kuchenstück abhaben, aber es dürfen jetzt auch nicht 25 italienische oder griechische Banken dabei rumkommen, weil dann wäre ja am nächsten Morgen der italienische Bankensektor tot. Also das muss man mit Vorsicht genießen, diese Stresstests, weil die sind auch zu einem gewissen Grade politisch beeinflusst. EU-wide Bank Stress Test 2016, participating German banks, Deutsche Bank, Commerzbank, DZ, Landesbank, and so on and so on. And you can see these are regular stress tests nowadays done by the European Central Bank and the European Banking Authority. And in other parts of the world, you will also see different and also similar types of stress tests. Any questions regarding backtesting and stress testing? No? Okay. Now let's turn to the fundamentals of financial derivatives. Completely different topic. Why? First of all, who does not know what a financial derivative is? Is everyone clear? Don't be shy. Everyone clear what a financial derivative is? Finanzderivat. Okay. Who of you has already taken a class with Professor Schumacher? Oh, okay, 2. Perfect. You'll basically learn the same thing in his lecture, but here with a slightly different touch to it. Can someone give me a definition of a financial derivative? What is a financial derivative? We'll see that a financial derivative is a financial instrument, it's a security whose price is derived from the price of another security, of a so-called underlying security. And this makes it A, quite difficult to price, and pricing in general quite difficult, and B, very interesting when it comes to risk management. Because in many cases, the price behavior is exactly opposite to the price behavior of the underlying. And if stock A goes down, a derivative will go, the stock goes up 1, the derivative will go down, and vice versa. And then you can use these instruments for hedging. To hedge, absichern, Absicherungsgeschäfte. And if you take a look at the research literature on risk management, in fact, most of the literature, the research done in finance on risk management uses risk management synonymously with financial derivatives. If a company uses a financial derivative, it does risk management. If you want to study risk management, you look at companies using derivatives. Derivative, risk management, derivative, that's basically the same in research at least. And we'll need almost all of the remaining time in this semester to talk about what types of derivatives are there, how can they be used, how can you find the correct price, what different methods do you have for option pricing. And as you can see, we'll start with the valuation or the pricing of linear assets. We'll need to think a little bit more how to come up with a price for a stock, a bond, and some other linear assets. Then I'll explain to you what a financial derivative is, give you some examples, and then we'll discuss probably the most famous model there is in finance, the Black-Scholes Merton model for option pricing. Nobel Prize winning model, and very simple, but a very fundamental model in finance. So let's start with the pricing of basic financial instruments. By now we know what linear assets are. Linear assets are those assets whose price linearly depend on the risk factors. For example, for a stock, we have one risk factor, the return on the stock. If the stock goes up €1 and we've bought 10 stocks, well, we'll earn 10 euros. That's a linear function. The risk and your profits are a linear function in the risk factor price. Same with bonds and so on. And later on for derivatives, we'll see that this is no longer the case. We'll have a non-linear risk mapping. Okay. So we'll start pricing. The literature reference here is quite interesting. It's a book called Derivate und interne Modelle. I don't know whether there's an English version to it. You can also look at the Hull textbook on risk management and option futures and other derivatives. But this one is quite interesting. Why? It has it uses a different notation and takes a different approach to it rather than the usual approach textbooks from management take. And the author is also very interesting, Hans-Peter Deutsch. Hans-Peter Deutsch used to be my boss. He ran the risk management department at Arthur Andersen. Arthur Andersen imploded after the Enron scandal. He then founded his own company, his own consulting company, Define, which I think now has 700 or 800 consultants. So that's half the size, I think, of McKinsey in Germany. Extremely successful. He became a guest professor of financial mathematics at Oxford. He wrote this textbook, and he, at some point, after having earned enough money, he became a yoga teacher. And after becoming a yoga teacher, I think right now he is doing scenic photography. So if you Google his name, you will see beautiful pictures. For example, of Aurora Borealis and some other natural phenomena. And it seems he's just a genius, not just in consulting, financial mathematics, but also yoga and photography. And he studied physics. And that's why he takes a completely different approach to these models than any other management textbook. So it's quite interesting to have a look at that model and the book textbook. Now let's start with equity investments, stocks. We've seen stocks. You all know what a stock is. A stock securitizes the property rights to a company. And what rights do you get? You have the right to get paid a dividend. You can vote at the general shareholders assembly. And you have the right to participate in a seasoned equity offering, bei einer Kapitalerhöhung. And If the company is sold off, if the company is liquidated, you get a part of the residual value of the liquidation value of the company. That's a stock. Everyone knows what a stock is. So let's just skip that. Voting rights, entitlement to a share in the company's profits, subscription right for new shares, and a part of the liquidation proceeds. And sometimes you also have a seasoned equity offering, an SEO. That's what we call in German eine Kapitalerhöhung. Is everyone clear why shareholders should be given a preferred right to participate in a seasoned equity offering? Warum haben Aktionäre ein Anrecht auf bevorzugte Teilnahme an einer an einer Kapitalerhöhung? Warum macht das Sinn? Imagine the two of us are 50% owners of a company. You own 50%, I own 50%. We need more capital. The company needs more capital. So if we increase our capital, say from 1 million to 2 million, someone else has to come into the company as a co-owner. Now we own 50% each of the company. If we want to, we should be given the opportunity to increase our investment to supply the company with more capital. And then, for example, I would pay 500,000, you would pay 500,000. We both remain at 50%. But if we do not want this, if someone else comes into the company, then he will get a 1 million euro share in the company. And for example, in this case, then we would own 1/3, 1/3, and 1/3 of the company. So our part in the company is watered down from 50% to 1/3. And for this reason, because our part in the company decreases automatically if we have a seasoned equity offering, at least the company should ask us first if we want to increase our capital investment. If not, then someone else can step in. But we have the first right to step in. Bei Kapitalerhöhung ist klar, wenn das Kapital erhöht wird, müssen die Alteigentümer gefragt werden, ob die möglicherweise als erstes junge Aktien kaufen möchten. Wenn sie das nicht wollen, kann es jemand anderes kaufen, aber ansonsten das Vorzugsrecht und das Vorgriffsrecht haben natürlich die Altaktionäre. Deswegen haben sie da eine besondere Stellung bei Kapitalerhöhung. Okay. In the end, most investors don't really care about the voting rights, the entitlement to a portion of the liquidation proceeds, and so on. What is most important in the end is the price of the share and the dividends. At some point, we will sell the stock for the then current stock price, and we will receive dividend payments on our way up to the point at which we'll sell the stock. So we have dividend 1, dividend 2, dividend 3, and so on, and it's one dividend T plus the stock price T. Now, what do we need to come up with a fair price of the stock price today? Very simple, very, very simple idea in asset pricing. The price today of a future cash flow is what? The present value of those future cash flows. You need an interest rate, and you calculate the present value of those future cash flow payments. Now, to simplify this even more, if we keep the stock long enough, you will see that at some point the sale of the stock takes place in the infinite future. So we have to discount it over an infinite number of periods, meaning the present value of something that is way, way back in the future is 0. So in the end, the only thing that is really interesting is dividend 1 plus dividend 2 equals dividend 3, and so on. So it's just the sum of the discounted dividends. Very simple idea, but in asset pricing, at least theoretically, this is the way to do it. We have no idea how to forecast all those dividends, but in theory, the stock price should reflect the discounted present value of all future payments. And in a simplified way, this is just the sum of the discounted dividend payments. Right? So, very linear model. Practice. You can also use factor models in which some idiosyncratic or macroeconomic variables are used. If you're interested in this, take up the book Asset Pricing by John Cochran, formerly from the University of Chicago. Best textbook there is on asset pricing, on theoretical asset pricing. John Cochran. He also explains it on YouTube in a number of videos. That's quite interesting. Now, the two differences between the present value approach and factor models is, like the capital asset pricing model, the present value approach is a normative approach. How should prices look like? If we know the dividends, then the price should be equal to the present value. So it's a normative approach in the sense that we want to know how prices should look like. Factor models go the other way around. They take the market prices as a given and they try to explain the market prices. Why are market prices the way they are? That's a positive approach. German, we have the same words. Normativer Ansatz und positiver Ansatz. Positiver Ansatz sagt, ich erkläre etwas. Normativer Ansatz sagt, wie müsste etwas sein? Wie müssten die Preise aussehen, wenn sie so, wenn das Modell stimmen würde? And then you have linear pricing and pricing of linear assets here in the case of a stock investment. Second important class, interest rate instruments, also called spot interest transactions or fixed income products. Fixed income, in many cases. Fixed income is synonymous for fixed interest rates, payments. Something that is fixed, and in many cases it means fixed by a certain interest rate. We distinguish between spot markets and future markets. It's a spot market, so we'll have transactions where financial instruments are exchanged and paid immediately, not in the future. And the spot market can then further be differentiated into money market and capital market. Money market, those are instruments with maturities up to 1 year. Everything with a maturity over 1 year is a long-term capital market. Capital is over 1 year, money is less than 1 year. Yeah. So we'll have these. Oh, something has gone wrong here. Those are zero bonds, obviously. A zero bond. That always happens when you have a large manuscript file and you see an error and you substitute something throughout the whole script. That slipped my correction loop. What is a zero bond? A zero bond is a security with only a single cash flow, the nominal amount, N, that is repaid at maturity. And let T be the term of the security, that is the due date given a start of the term at T equal to 1. Then the cash flow of the zero bond is simply given by minus the price 0, 0, 0, 0, 0, 0, and then at some point N. So the cash flow at repayment at capital T is N. That's a zero bond. The value of the zero bond is simply given by what? You take the notional amount, you discount it, and the discounted notional is your price, it's the value. Remember that I told you that you can use discount factors like this, but you can also use the bond prices, the zero bond prices of zero bonds with a standardized or normalized notional of 1. And this is BRT to capital T. This is the discount factor, and in this case the zero bond price with a notional of 1. Because if you have a price P 0, 0, 0, 0, 0, 0, 0 and a 1 here, then you would take 1 divided by 1 plus R here, and this obviously then is the discount factor. Zero bond price is a discount factor. And on the following slides, the discount factors, BR, they are stated depending on a constant interest rate. In practice, R will of course be non-constant for different maturities. And this is the important distinction between a flat interest rate curve or yield curve, a normal interest curve or yield curve, or a so-called inverse yield curve. Wir haben the same flache Zinsstruktur, normale Zinsstruktur oder inverse Zinsstruktur. And for example, we have 1 year, 2 years, 10 years. Okay. For a zero bond, what determines the price of a zero bond? If the price is simply given by notional n discounted, the only thing that can change is the interest rate level. And this is why in many cases interest rate products and instruments and fixed income products have the interest rate level or interest rate levels as the sole risk factor that affects prices. And this becomes immediately clear here with the zero bond. The notional is fixed, the maturity is fixed, the only thing that changes is their interest rate. Okay. Then let's turn to a so-called floater or a floating rate note. It's a security whose cash flows are variable interest rate payments with repayment at the end of the term, and the variable interest payments refer to a reference interest rate, for example, the Libor or the Euribor, in case it's not currently manipulated by one of the German banks. You have a notional N, and it yields the reference interest rate over the relevant interest period, and even though it's a variable interest rate, the variable interest rate payment is determined at the start of a fixed period for payment at the end of the period. For example, if we take now the month June, a floater, with a floater, you would, on the 1st of June, you would look at the current 6-month Euribor, let's say it's 2%, meaning that at the end of June, you have to pay 6%. In July, on the 1st of July, you would again look at the Euribor. If it's, say, at 3%, then you would have to pay 3% at the end of July, and so on and so on. So it's not completely flexible and completely variable, but you have so-called fixings, and with these fixings, the interest rate is fixed for the next period. Now at this point, one would think that a floater is a very complex and very complicated instrument. You don't know how the interest rates will look like in 2 months, in 1 year, in 5 years. And one would think that coming up with a pricing formula for a floating rate note is quite difficult. Well, actually, it's very simple. You have different types of floaters: collars, reverse floaters, cap and floor floaters, money market or capital market floaters. Read through it. Those are different types of floaters. Let's rather turn to the pricing. we assume that we are at time t. T is between t1 and t0. The cash flows are now given by the following numbers. The interest rate payment that has already been fixed is notional times BR that has been fixed, taken to the minus 1th power, minus 1. What is that? That is just you take the discount factor and revert it back to an interest rate. So it's R times N, right? So this is R fixed times N, nothing else. The future payments, they are variable. However, you have N, the notional, and the variable interest payment between at time ti is the then current discount rate or interest rate, BR, ti minus 1 to ti, seen from the current day t, times the notional amount. Again, we don't know what this discount factor and the corresponding interest rate will look like. We only know it will be the interest rate that is current at ti minus 1. That will have to be paid at ti, right? If we were to take, say, December, we would know that at the end of December, we would have to pay the interest rate at the start of December, that is ti minus 1, times the notional, say 1 million. However, we can change it a little bit, and if you have seen this, what is this? Especially this way of writing an interest rate. This is a forward rate, in contrast to a spot rate. Now, this is something my professor actually did quite well. In my studies, spot rates were written like this. And forward rates were written like this. For example, the spot rate is the interest rate for lending or taking money today until time t in the future. For example, if I were to give someone of you a loan today for 3 years, then I would have to look at the spot rate for a maturity of 3 years. The forward rate is the interest rate that we agree upon today for lending from t dash until t star in the future. So an example for a forward rate could be a 5-year interest rate agreed upon today in 2019 for a loan that starts in 2023 for 5 years. That's a forward rate. And it's very easy to see that this holds. The forward rates and the spot rates in an arbitrage-free market must be consistent in a very special way. Because I could do the following. If I know that I will have to lend money in 2023 for 5 years, I could simply take money today, leave it for 1 year and 2 years, and you can easily see that the spot rates and this forward rate is equivalently given by these two spot rates today, let's say 2019, with a 5-year and an 8-year maturity. That's 4-year maturity. These are spot rates and forward rates. And down here, you simply converted this forward rate here. This is the forward rate, or the discount factor that corresponds to the forward rate, to the two discount factors that correspond to two spot rates. Is that clear to everyone? I would hope that spot rates and forward rates have been discussed in the finance introduction in the third semester in the bachelor's degree. Ist jedem klar? Spot Rates, Forward Rates, Kassakurse, Forward-Kurse können natürlich, also auf dem arbitragefreien Markt sind die äquivalent. Ein Forward-Kurs kann immer umgerechnet werden über die zwei Spot-Kurse. Also ob Sie jetzt sagen, ich vereinbare heute eine Kapitalüberlassung ab 2023 für 5 Jahre, das muss natürlich übereinstimmen und muss passen zu den Spot Rates heute bis 2023 und heute bis 2028. Wenn die Zinssätze nicht zueinander passen würden, müssen Sie das Geld ja einfach nur irgendwo hinlegen und warten, dann können Sie eine Arbitrage konstruieren. Und das hier unten ist links noch ein Forward-Kurs, also der Zinssatz, oder besser gesagt der Diskontierungsfaktor zum Zinssatz, der in T vereinbart wurde, für die Kapitalüberlassung TI-1 bis TI. Und das können Sie umwandeln, ganz äquivalent, in dieses Verhältnis hier der Diskontierungsfaktoren für T bis TI-1 und T bis TI. Das ist also ganz simples Rechnen mit Spotkursen, Kassakursen und Forwardkursen. Okay, if you have no questions, let's assume you've understood it. The final repayment is N. Thus, altogether, the present value, the fair price of a floating rate agreement should be the fixed payment we already know, discounted, plus the discounted future variable interest payments, plus the discounted notional repayment. That's line 21. Fixing or fixed interest payment, variable interest payment, plus the repayment of the notional. Now, what can we do? We simplify equation line 2 here. Actually, that's 20. The second one. And you see, if you multiply this in here, you see, in fact, you will get this. N times the sum I equals, starts from 2, goes to N, BRT TI minus 1 minus BRT TI. Two spot rates. Okay. Let's simplify this term here. Write it out and you see what? It's BRTT1 minus BRTT2. TT2 minus TT3. TT and so on and so on. And what happens is TT1. It's made even simpler. We can leave out the first one. It's T1 minus T2. T2 minus T3. T3 minus T4. T4 minus Tn. And then you see this is the same, this is the same, this is the same, this is the same, and so on and so on. And the only thing that is left is this one and this one. So BRT until T1 minus BRT until Tn. This one and this one. So all those discount factors in the future, they actually disappear. Next, the floating rate agreement can be priced by, well, go back here, we know this, and then we'll have here N times BRT T1 minus BRT Tn. The sum is gone, and if we now combine it, you will see it's the discounted fixed interest payment plus N times the difference between the swap rates plus notional times the last discount factor. And if you now simplify it even more, if you combine it, you will see that the present value of a floater is given by what? Discount factor for one period times the notional plus the already fixed interest payment. In other words, notional times the discount factor for 1 year and the already fixed interest payment. In summary, a floater is nothing but a zero coupon bond with a nominal or notional amount of N plus the fixed interest payment and a maturity of T1. And this is the surprising result here, because one would think that with a variable interest or an instrument that pays out variable interest payments, we would get into huge problems when pricing such a floating rate agreement. However, it's very simple. And why is that? Because not only the payments are variable, but the discount factors are also variable in the same amount. So if the interest rates increase, you will get a higher payment, but you will also have to discount your payment with a higher interest rate. And that's why, in this case, the floating rate note is quite simple to price. The present value formula for the arbitrage-free price of the floater is quite simple. And we don't need to forecast the interest rate levels in 5 years, 10 years, and so on. We only need one. That's all. We didn't consider a margin spreads in the previous valuation, but this is quite simple to include here. It can be duplicated. For example, a long position of the floater with spread K can be duplicated by a portfolio consisting of a floater long without spread, a coupon bond long with a spread as a coupon, and a zero coupon bond with a nominal value and maturity of the floater. Think about it at home. It's a very simple concept. In many cases, when you have a slightly more complicated financial instrument, think about it how the cash flows look like. For example, if I was given something like this, this could look like a bond, a coupon bond. But I could also say, well, this is actually 5, 5, 5, 5, 5, 5, 5, 5, 105. This is a coupon bond, and 0, 0, 100, and 0, 0, 0, 0, 0, 100. And suddenly, if I combine these three, I have a portfolio of a coupon bond and 2 zero bonds, and I would get this financial instrument. That is the easiest way of describing financial engineering. You have basic financial instruments, you have a desired cash flow, and you combine those basic financial instruments in a portfolio to come up with the desired cash flow stream you want. This is a very simple example, but if I ask you, what is the price of this instrument here? You would simply have to take price 1, price 2, price 3 of those 3 basic linear assets, add them up, and then this should give you the price of this more complicated financial instruments. That's what it's called financial engineering in its simplest form, because you're combining assets to form new assets, new financial instruments. And this can also be seen here in the floater with a spread K. It's a floater with an additional spread included, then just duplicated with simpler linear assets. And then, if you take the coupon payments from a bond, that is called stripping. You strip the coupons from the bond. Okay. And as we have seen, a floater in terms of valuation is nothing but a zero bond, again. Therefore, either the spot rate or the yield to maturity of the floater can be used as risk factors. Again, the only risk factor you really have here for a floater is the interest rate, the current interest rate and the level of interest rates. Again, it's a linear asset. It's just included in the discount factors. Okay. Now I've already run out of time, I see. Do you have any questions? We'll continue this with the coupon bond and a swap contract, some additional linear assets. And as you can see, after the forward rate agreements, we'll turn to options, financial derivatives. And I would ask you, if you do not know what a financial derivative is yet, take up a textbook or go to Wikipedia, read the definition so that you are versed in options and simple plain vanilla options and derivatives, and we'll continue our discussion of linear assets and then derivatives next week. And if you have no questions, then thank you for your attention and see you next week.